Okay, in part two, we're going to continue with some basic concepts in finance and making financial decisions for the company. So we want to talk briefly about business ethics, and obviously they are the standards or the conduct or moral judgment, if you will, that apply to people engaged in commerce. I mean, that's obviously business ethics, but ethics in general, right? We want to typically we talk about the golden rule, right? Don't do something to somebody else that you wouldn't want them to do to you. So when you violate this basic rules, right? And there's lots of ways that companies have done this that has shown up in the news lately, right? There's this creative accounting or aggressive accounting management, earnings management, misleading forecasts, insider trade. All of these activities are ethical violations, right? Most of them, as you read through them, are at the least are illegal, but they all have a negative impact on the publicity for the company. They could have negative impact on cash flows, but it also has an influence on investors and how they view the company. So with respect to ethics, most business programs have some form of an ethics course. Now, we can't teach you to be ethical, but we can teach you to recognize ethical questions and possibly create some techniques so that you can determine the most ethical way to perform an activity, if you will. Warren Buffett once said, and this is just paraphrasing, this said, if you come to him and you ask them about a question because you think it might be unethical, right? He basically says this: look, if what you're going to do, if that was in a newspaper tomorrow, and your mother was going to read that article, how would you feel? And I think the answer is obvious. If mom would be unhappy, if mom would not be quite as proud of you anymore, then maybe it's unethical. Another concept that's tied to how people act, right, is something referred to as agency. Agency is a principal-agent relationship. This is where the owners of a company, acting as principals, hire the people that work in the company. They elect management, if you will, or hire management to act in their behalf. So what an agency problem is when managers place their personal goals ahead of the goals of shareholders. Shareholders hire them to act in their best interest, but sometimes managers act in their own best interest. The challenge with this is that is not free. There is a cost to this. It's referred to as agency costs. So these are the expenses that come from this conflict between shareholders and managers. Now again, there is also a conflict between the owners of a company and the creditors of a company, that sometimes we won't do things that are always in the best interest of our creditors. So whenever a manager owns less than 100% of the company's equity, there's a potential agency problem. In theory, managers would agree that shareholder wealth maximization is what they want to do. However, they're also concerned about their personal wealth, job security, fringe benefits, lifestyle, right? This might cause managers to act in ways that are different from shareholders. And in a very kind of an absurd question, right, is, could you see a sole proprietor do something intentionally that would damage their wealth or will they always do things to try to make themselves better? And of course, this is obvious. Sole proprietors do not have agency problems. So one question that we can ask is, how can we get managers to act in shareholders' best interest? And there are four basic ideas or four concepts that we could employ, right? The labor market for employment is very powerful. If managers can't do the job that they're hired for, we fire them. And if that happens often enough, they would be damaging their supply curve, right? The amount that they'd be willing to, their demand curve. People wouldn't have a demand for their services, which would lower their future potential earnings. There is a labor market that's also associated with takeovers, right? If we can't maintain a high stock price, or a stock price that's as high as it should be, right, we might be open for somebody to come in and try to take over our company. And essentially what happens in takeovers is most of the time the old the old managers are fired. They replace the old management team with the new management team. We could audit the company's books to help us keep a little bit better track of what's going on inside the company. But one of the best ways to do this, quite frankly, is actually through a compensation plan, right? How should we pay employees so they act exactly like owners? Well, the most obvious answer for this, hopefully, is we should pay them with stock. And what typically happens is we pay them with something called a stock option. So an option is the right to buy a stock at a certain price within a certain period of time. So again, what this essentially does is creates another place where people can buy stock. And of course, if you could go to two stores to buy something, and one store sold the exact same thing slightly less than the other, where would you go to buy the thing that you wanted to purchase? So for an option here, you have an option to buy a share of stock at $50, and currently the stock price is $35. So where would you go to at this time to buy this stock? Would you buy it from the market for $50, from the company at $50, or would you buy it from the stock market at $35? Obviously, you go to the market. But if management does the right thing, eventually the stock price will go above the $50 option. So the option is $50 or $65. So, if you wanted to buy this, where would you go to buy the stock, right? So obviously you want to buy the stock in the place or from the place that has the cheapest price. In this case, buying the stock through the option at $50 is better than paying $65 to the market. So let's continue talking a little bit about some fundamentals of a corporation and decision making. So corporate governance refers to the rules and processes, right, that companies are operated by, right? It defines the rights and responsibilities of the corporate participants. That is, it sets up the game book, essentially, for how shareholders are treated, how the board of directors, officers, managers, how these different factors, these different entities, how are they treated in the operations of the company. We have two kinds of investors to think about. We have individual investors. Typically, they own relatively small quantities of shares, right? They're looking at this to meet their personal investment goals. And we have institutional investors. These folks have typically very large holdings. These are banks, insurance companies, mutual funds, pension funds. Unlike individual investors, institutional investors really watch what goes on inside a company, right? They will exert pressure on management to perform. They will have access to the upper levels of management to communicate, to ask questions about what's going on. Now, this isn't the way the world has always been. Historically, in the very beginning, if you think about the early 1900s, the late 1890s, most big corporations were owned by really a small number of people. So those people had a great influence over management. In fact, typically they were the management of the company. But this has changed now, that institutions have a much greater influence on what goes on inside a company than you and I do. And that's really a very good thing, because you and I don't have the time or the resources to really pay close attention. I mean, real close attention to what goes on inside a corporation. There are some some regulations that are important. The most important one, at least with respect to making decisions inside the company, is something called the Sarbanes-Oxley Act. And quite frankly, we're really only interested in a couple of things here, right? We want to understand what this act does and how it influences financial decision making. It toughens penalties against executives who commit corporate fraud. Historically, these penalties were civil penalties. Now they are criminal penalties. They've strengthened accounting disclosure requirements, right? They're tightening up the regulation of activity and how things are disclosed. They also have established some corporate board structure and membership guidelines. So they've put in place some things that I like to refer to as they increase the quality of the information that we get. That is, because of the criminal element, because of the requirements for disclosure and guidelines for corporate offices, because of the way corporate boards are structured and how they work now, the information that you and I get to use to make financial decisions is much better. It's less likely to have bad information or irrelevant information or, quite frankly, false information. So we want to talk about and finish up with a couple of concepts to think about. And the first thing we want to talk about is something called marginal benefits. In this example, a company is considering a replacement of a brewing kettle in its beer factory. The total benefits in today's dollars is $500,000. Now, the old kettle would produce about $400,000 in benefits, again in today's dollars, over the same time frame. This new kettle is going to cost $150,000 to buy and install, while the old kettle could be sold for $70,000. So here are our questions. What are the marginal benefits? Well, the idea here is with the new kettle we get $500,000. With the old kettle we get $400,000. So marginal means what is different if we move forward. In this case, we would have $100,000 in benefits if we change from the old kettle to the new kettle. What are the marginal costs? Well, it's going to cost us $150,000 to install the new one, and the old one's going to give us $70,000. So the actual cost is a net cost of $80,000. So we're going to receive $100,000 in marginal benefits, but we're going to have to pay out $80,000 in marginal costs. So the net benefits, $20,000. And since there is a net benefit, the idea here is who gets the benefits? Benefits go to the owners of the business. So if this was a sole proprietorship, the owner would get all $20,000. If this was a corporation, the company itself gets the $20,000, and indirectly the owners get the $20,000 because they own the shares. Cash flow analysis is another aspect we want to kind of think about, right? What is the difference between cash and profit? So here we have a company has $600,000 in sales. 25% of that they receive in cash. The rest is on accounts receivable. Cost of goods sold is $450,000. Again, we pay 75% of that is paid in cash. Interest expense is $30,000. And of course, we paid all of that gets paid out in cash. And the tax rate of this company is 20%. So we want to calculate the income statement and the cash flow statement for this company. So if you look at the income statement, $60,000 in sales, cost of goods sold, earnings or operating profits $150,000, interest expense $30,000, earnings for taxes is $120,000, and the taxes we pay are $24,000 on 20% of that. So the net income is $96,000. That was what the profit of the company is. But let's look at the cash of the company. They only received $150,000. They actually paid out $337,500 in cost of goods sold. So their operating profit in cash flow terms is negative $187,000. They had to pay interest, so now that's negative $217,000. They had to pay the taxes of $24,000. So the net cash flow of this company is negative $241,500. So the question is, how long can the company last with this type of net cash flow? Now, it is true that they are going to receive the remaining $450,000 in sales. But the question is, how soon does that get here? Right? They will have to pay the remainder, the $120,000 in cost of goods sold. They will have to pay that, right? But when will they have to pay that? This is a question of operating the finances of the company. So the last thing we want to talk about is a tax example, right? So here is the taxes of the company. How would you calculate the taxes if you earned $4 million? So let's think about the process. You find the tax code. Here is the brackets. We find the amount. It's on this line. So here's the formula. It's $113,900 plus 34% of the amount over $335,000. When you calculate this tax, that'll be $1,360,000. So what's the net income of the company? $400,000 minus the tax gives us $2,640,000 is the net income. The average tax rate is the 1.36 million divided by the 4 million. That's 34%. The marginal tax rate is identical. It's 34%. What we find is as you make more and more money, the average tax rate and the marginal tax rate, they come together. They converge with each other over time. What about $78 million? Again, we're on this bottom line. $6.4 million plus 35% of whatever's over $18.3 million. The tax, $27,300,000. I mean, would you want to pay $27 million in taxes? Well, yeah, if you were making $78 million, I think I could live on that. You'd have net income of $15.7 million. The average tax rate, 35%. The marginal tax rate, 35%. So we can see that calculating taxes is not that difficult. What we have to understand, what you have to keep in mind is that there was a major tax code change. So this is the corporate tax code. These numbers have changed dramatically. Currently, the highest tax is 21%. So we have to figure out, and it really doesn't matter what the tax schedule is, you calculate taxes the same way. We need to be able to understand that the tax code will change from time to time, which will change our liabilities. And finally, what is it that we have to understand? What are the things that actually guide managers' decisions? Number one, the time value of money. Money loses value over time. We need to understand there's a trade-off between returns and risk. We'll discuss this a lot more later on. Cash is king. Without cash, you cannot do anything. So cash is a far better number to talk about than profits when you're talking about whether a company is doing better or worse. And finally, we live in a world of competitive financial markets. Supply and demand is in place. Now, that's not true strictly for everything, but in general, if you understand supply and demand, if you understand how cash relates to decisions, if you can understand how risk and return play with each other, and you can apply these concepts to something called the time value of money, you understand how managers should make decisions.